This is the Clear Money Talk podcast, offering up creative solutions for your retirement future through education, choice, transparency, and empathy. Now, your host, CEO and founder of Clear Financial Partners, Tim Claremont.
Welcome to Clear Money Talk. My name is Tim Claremont. I am your host, the CEO and founder of Clear Financial Partners. And as always, your co-host is here with me, Mr. Tyler Andrews.
Thank you, Tim, for the introduction. It's good to be here. We're in the podcast studio. I love starting out our podcast by saying that. It's probably obvious that we're in the podcast studio because we're recording a podcast, but I feel like it's worth being said.
You know, every now and then, it's always good to say the sky's blue. Just because it reminds you that the sky's blue.
Well, up here in the Pacific Northwest, sometimes the sky is not blue. Sometimes it's very gray.
That's fair. Yeah. And maybe that'll somehow relate later to what it is that we're talking about today, where the obvious is maybe not always obvious.
That's true. So that'll be a component to today.
We'll see what we can do. What's our question that we're going to answer today? Clear Money Talk is always about answering the money-related questions you want to get answers to so that you can understand how professional, insurance and financial advisors think about these money-related problems. So let's see what we can do to share some answers today.
That sounds great. All right, topic of the day, year-end checklist. Are your finances in order?
Ooh, are your finances in order from a year-end check? Don't you feel that question? It's like, oh, man, I don't know. If your gut tells you when you hear that question, I don't know or no, you probably need to do something about it, right? That's why you're listening to this podcast. We'll give you some insights. If your gut tells you, yeah, I feel like my stuff's in order, let me just do a double check. Good for you. I'm glad you have that feeling, and this double check should still give you a good sense of peace after you go through the rest of it. But we can't cover everything that needs to be done in a year-end checklist. There's just so many different unique circumstances that everybody has, but we're going to cover a lot of the common ones that people deal with at the end of the year, just to make sure that we check the boxes on some of the basics that we deal with on a regular basis for our clients. So, where do you want to get started?
Yeah, I think let's hit the kind of the topics that I thought would be of importance to the majority of listeners, and then we can just kind of go through each of them really quickly in a summary capacity, talk about what they are, what they mean, why it might make sense for you to take a look at that before the end of the year, especially before the end of the year, and just kind of move through them that way. So the topics that I wanted to talk about today are RMDs, which stands for Required Minimum Distributions, tax loss harvesting / rebalancing, maximizing retirement contributions, planning and processing and executing charitable contributions, as well as reviewing your estate plan and your beneficiaries. So some of this stuff might be applicable to you as a listener. Some of it might not be. Some of it might be applicable to everything that you're doing, which is great. But regardless, I think it'll at least be good learning opportunities, whether it's applicable to you or not.
Yeah, that's fair. That's a good. That's a thorough list. So we'll hit some of the basics, and I'm sure there's a few things that aren't on that list that are still good to keep in mind from a year-end standpoint. But I think that's a good list for us to tackle.
Does anything come to mind that maybe?
Actually, no. I mean, that was pretty thorough. I mean, everything for, retirement income planning maximization, RMDs, tax loss harvesting, also referred to now as tax deduction creation, which is always fun. So that'll be fun.
Insurance maybe might be one of them. Reviewing your insurance, your policies.
Making sure. I think the 5 principles of financial planning is another good way to approach the any kind of checklist to see if you're doing a good job. And the first of the 5 principles is rate of return. So I think optimizing your investment allocation, but that's really a year-round issue. It's something you should be doing all the time. It's not something you do just at the end of the year. So if you haven't done that, we're not going to talk about it on this particular call, but it's something you want to make sure your investments are in the right place. And then retirement income planning, of course, always optimizing that. That's where things like the RMD come into play.
That's right.
Require minimum distributions as well as maxing out the qualified retirement plan contributions. All of that comes into play. So two of the items we'll talk about today are directly related to retirement income planning. And then when it comes to tax planning, that third of the 5 principles, we talk about things like the tax loss harvesting or tax deduction creation. So that kind of fits right into that category. And there are several other things from a year-end tax standpoint that we're not talking about in this show, because we're not an accountant. We're not out there to give you tax advice. We're just exposing you to some insights as it relates to some of the tax information that's out there. But there are definitely a lot of things to consider doing at the year end from a tax planning standpoint that you'll want to discuss with your tax attorney or accountant or your financial advisor that's working together with those other individuals to make sure that you're optimizing your business tax deductions that might be available for you. Things like, I'll just leave you curious. If you're curious, you can give us a call, and I'll connect you with an accountant professional that we work with on a regular basis to try to make sure you're checking the boxes on all those tax deductions and year-end tax planning strategies other than what we're going to cover today.
Yeah, that's great.
Finally, estate planning and then protection planning. Yeah, making sure you're adequately protected. That's the fifth of the 5 principles. And then estate planning, obviously having your legal documents in order. Always a good experience to go through, but that's more of a year-round thing as well. So let's hit it. What's first category one? RMDs.
Required minimum distributions. If it's not applicable to you yet, you might have heard this word before. RMDs, required minimum distributions. What does it mean? Essentially, the gist of it, the short end answer is, you have pre-tax money in your retirement plans, whether that's 401ks, traditional IRAs, SEP IRAs, simple IRAs, things like that. And you can defer taking money out of there if you'd like to, but at a certain point, the government, Uncle Sam, he's going to say, you know what, Tim, Tyler, I've let you defer paying taxes on that money for long enough. It's time to start taking some money out, paying the taxes on it, so I can collect my share of all the gains and earnings of your money being invested for all those years. So essentially, it's a way for the government to force you to start taking mandated withdrawals from your pre-tax retirement assets, so that way they can collect their tax dollars on it. And they have continued to move the age over the, at least since I've been in the industry, they've moved that at least 2 or 3 times now. It used to be 70 and a half. It went up to 71, I believe. Then they pushed it to 72, and now they're even talking about pushing it to 70.
I think it's 73 now, and
73,
it's going to 75 for
that's right, 73
for
now.
People below certain ages. There were a lot of changes made in the Secure Act and the Secure Act 2.0 that were related to required minimum distributions, and it's been a nice thing in some ways that they're pushing the age out so you don't have to start your distributions as early. And it's also been kind of a nice thing in that they're pushing out the penalty. They're pushing down the penalty. There used to be a 50% penalty tax on a required minimum distribution that was not taken, that was supposed to be taken. So what does that mean? That means, let's say you had $1 million in a pre-tax retirement account like a 401k or IRA. Lots of clients have that kind of money in their retirement accounts when they go to retire. So say you got $1 million in that account. And the required minimum distribution, whether it's at 70 and a half or 73 or whatever age it was for you, or it will be for you when you get there, is probably somewhere around 4% in that first year. So it's on $1 million, about $40,000 approximately. Obviously, double check with your accountant and actually double check the actual accuracy of the RMD in any given year that you're looking at this. But for purposes of our example, let's assume it's $40,000. Well, $40,000, if you didn't take it out, it used to be the penalty on that was half of what you were supposed to take out, meaning $20,000 penalty if you didn't take $40,000 of your own money out because the IRS wanted to get paid, and they were saying you got to take that money out. So, but the difference is that was rarely enforced, even though it was there, even though that rule was there. If you kind of owned up to the fact that you didn't take the distribution, they'd let you accelerate and take extra distributions in 1 year to catch up for the stuff you missed previously, and many times the IRS waived the penalty. Well, the penalty has now dropped. They've dropped it to like 25%. And I think most recently it was looking at being dropped to even 10%.
That's right.
If they drop the percentage penalty, that should tell you something. To me, that tells me they were likely to start enforcing it. I think it was so ridiculous and so high that they just felt like it was not legally maybe reasonable for them to enforce it. Now with a 10 or 25% penalty level, I think that's actually a lot more likely to get enforced, and that's going to become a revenue source for the IRS for those of you who miss those RMDs. So make sure you don't miss your required minimum distributions.
Well said. Yeah, 100%. And that's why we wanted to talk about it. Year-end checklist. Make sure if you have an RMD, you take it and talk about that with your financial advisor and your CPA, your tax accountant, just to make sure everyone's looped in and you get it satisfied by December 31st.
Yeah.
Or if it's your first year for taking RMDs, they actually give you a little bit extra time leading into the next year up to your tax filing deadline to do that as well. But again, talk to your CPA about that.
Yeah, you double check with your CPA. I think it might actually be April 1st of the year following, not even necessarily your tax filing deadline, but
April 1st,
double check and make sure. You got to be careful.
Yep.
So that's RMDs, and we always do that for our clients. We go through and double check to try to verify that everybody's covering their required minimum distributions.
That's right.
But at the end of the day, we don't. We want to make sure that that's taken care of. You got to take some ownership over all of your pre-tax retirement accounts, your IRAs, your 401ks, things like that. We only know the accounts clients have invested with us, and we can certainly help guide them on those accounts. But if they have something that's not with us and they fail to take their RMD on it, we're not able to assist them with that because they weren't investing it with us. So
that's right.
Make sure your planner knows what you're doing as well, even if you think you're doing some stuff on your own that, you've got your own way of doing it. Everything works together when it comes to the IRS. So make sure you're aggregating all of that information and making appropriate tax decisions.
That's right. Okay, I feel good with that one. Next topic is tax loss harvesting and rebalancing of a portfolio. So, Tim, you were just somewhere where they were talking about tax loss harvesting, which is a strategy in taxable accounts, like your non-qualified brokerage accounts, where you're selling things at a loss to realize losses to help offset gains that your portfolio also realized that year to help offset the tax implications of that. But you heard a new phrase, a new way of saying it, which is worth being said, I think.
Yeah. So I was meeting. Thank you for
of course,
teeing that up, Tyler. I was meeting with several other insurance and financial advisor specialists from around the country. We were meeting in Cleveland, Ohio, and this last week I spent 3 days nerding out with them about tax rules and all kinds of tax-related stuff. Specifically, one of the ideas that we discussed was tax loss harvesting, and it's actually being referred to now by the organization as tax deduction creation, because that's essentially what we're doing. You might have some stocks or some other highly appreciated investments that you want to hold for a long period of time. And they may have some losses in the short run. Maybe you were investing in them on a regular basis, and one of those values went down right near the end of the year. So if you were to sell it, you could generate a tax loss, but you still want to hold the position long term. So one of the strategies that can be implemented is you can sell the position, stay out of the position for typically 30 days or so to avoid what's called a wash sale, and then repurchase that position again at the end of that period of time. But it'll trigger a loss that you can then take as a tax break on your taxes for that year. And other times you might want to actually trigger a gain to take advantage of the fact that you might be in a low tax bracket. Maybe you're in a capital gains tax bracket of 0, which is very possible. And if you're in a state with no state income tax, like Washington or Nevada or Tennessee or Texas or Florida, you might want to go ahead and recognize some gains that you might not owe any taxes on because of your tax bracket. So we call that bracket bumping, taking advantage of those lower tax brackets while you're in those lower levels. And there is, in fact, a 0% tax bracket on long-term capital gains if your income is low enough in that scenario. So taking advantage of bracket management, and then ultimately taking advantage of adjusting your portfolio to optimize your taxes. That's what tax deduction creation is about, also referred to as tax loss harvesting by some.
It's more common to hear the tax loss harvesting, although I do like tax deduction creation. I think it's fancy and it's easier on the ears, I feel like. Something that goes hand in hand with that is rebalancing of a portfolio, which similar process is you are adjusting things inside your portfolio to bring your positions and your intended allocation back in line with the intended allocation. As things appreciate in value and depreciate in value, your portfolio can get out of whack, essentially. So things can become a larger percentage of your portfolio when in reality you wanted them to be a little bit smaller. And that happens naturally as assets appreciate in value and also depreciate in certain examples. So rebalancing is selling and buying things in the portfolio to bring it all back into the intended allocation and target. That can be important for a lot of people to stay within your risk tolerance. As things get out of whack in the portfolio, it can fall out of your risk tolerance and your targeted allocation. So it helps realign everything that way, and it also helps from a diversification standpoint. You can have a one or multiple positions in your portfolio become much larger than really what you want it, and that can get you away from the whole diversification of a diversified portfolio. So rebalancing is also something to consider, at least as you near the end of the year. A good line in the sand is the end of the year, just to take a look at your portfolio and to see if a rebalance makes sense. We sometimes do them at Clear Financial Partners on a quarterly basis, but at least once a year I think is prudent to give consideration to.
We often will discuss that allocation with clients at their review meetings. Sometimes it's annually, sometimes it's more regularly than annually, depending on the frequency of the client, the complexity of the situation. But one thing I would say I've used as an analogy, again, I think they say the picture's worth 1,000 words and analogy's worth 1,000 pictures. So it helps to visualize what we're talking about when we're talking about rebalancing. I was just driving back from Bend yesterday with Crystal, and we were heading back. We stopped at one of my favorite restaurants for pizza, which is the Zigzag Inn.
Square pizza?
Yeah, they cut those in the squares when you get the larger size. But I was disappointed because I got the small size.
It
tasted
circle.
just as good. It was a circle, and it was it's cut in a traditional pizza kind of way. However, it still tasted great. My point is, when it comes to a pizza, if you think about a typical circle pizza, that represents 100% of your portfolio. And the slices of the pizza may not all be the same size. Some might be smaller slices, some might be larger slices. And that represents the percentage of your portfolio that you might have invested in stocks or bonds or cash or international stocks or domestic stocks, large, medium, and small companies. All of those different categories that exist in a portfolio might include what you might have in alternative asset classes like cryptocurrency or other aspects, real estate for that matter. And if that pizza represents your entire net worth, as soon as you like the shape of that pizza and you like the sizes that you've cut of all those slices, the very next day, those slices start to change in size. Some of them get bigger, some of them get smaller because some of those assets are growing at different paces. And by the end of a year, you may find that the pizza looks really funky. And the whole point that Tyler's talking about is things get out of whack. It's kind of like aligning the tires in your car. It's just making it drive straight again and just getting those pizza slices back to the shape that you intended originally. And that's particularly important if you've had a really, really successful or really, really dismal performance in a particular asset class, because that pizza slice either got really big or really small. And that requires consideration of adjustment.
I like that. I like the analogies. The analogies are always nice, and Tim, you always bring those to the table, which I appreciate. I think that wraps it up for the tax loss harvesting and rebalancing. Next is the maximizing retirement contributions. This one should be one of the easiest, I feel, that people can pick up and run with. If you're working and your employer has a 401k, or if you don't have a 401k through your employer or other defined contribution plan, hopefully you have an IRA or a Roth IRA, something that you're saving into in a retirement capacity where you're limited with how much the IRS lets you put in on an annual basis. So with that being said, if you have ambitions and goals to make sure that you're maximizing those retirement contributions by the end of the year, definitely make sure that you give consideration to, hopefully throughout the entire year you're doing this, but at a minimum, as you're getting closer to the end of the year, take a look at how much you've contributed year to date. And if there's any room left over between what you've contributed and what they allow you to contribute into those types of accounts, give consideration to adding more money to that retirement account to get up to the cap or the maximum that they let you put in. It can often be a big lift to do those things, but the unfortunate thing is you can't go back when you're older and you have more money to put in money that you would have put in back in the day when you didn't maximize those retirement contributions. It's a take it or leave it situation, and if you can, I recommend taking it while you can and stuffing as much in there at that time, and not missing that window. So maximizing retirement contributions is definitely something to give consideration to as you're getting towards the end of the year.
Absolutely. I agree with everything you just said, Tyler. That was solid. And every year there's a little bit of a different number as far as the maximum amount that you're allowed to contribute. So in 2024, if you're under the age of 50 years old, the maximum contribution limit for IRAs and Roth IRAs is $7,000.
$7,000, yep.
And if you're under the age of 50, the maximum contribution on a 401k as an employee is $23,000.
That's right.
However, if you're 50 years old or older, there's something called a catch-up provision that allows you to put in extra money into IRAs and Roth IRAs and your 401k. 401k allows you to contribute all the way up to $30,000, I believe, and that 23 plus 7. Is it $30,500?
$30,500, yeah. They bumped the catch-up from $7,000 last year, and now in 2024 it's $7,500.
Beautiful. So even more room, $30,500. And the other thing is if you actually are self-employed or you work with an employer that enables you to do something called a mega backdoor Roth IRA contribution, you could actually contribute all the way up into the $60,000 range and even over $70,000 if you're 50 years old and older, because of the extra room that you have in those kinds of accounts. So you might think you've maxed out your accounts, and yet you might not have. And that's a good thing to double check with your financial advisor to make sure you're really hitting those ceilings. I remember when I was 21 years old and I first started doing financial planning right out of college, and I learned about these limits on qualified retirement plans at that time. And I felt like I would physically be nauseous if I didn't max out my 401k that year. 21 years old, and I was just grinding, just trying to work to make ends meet, pay rent and put food on the table and all that good stuff. And but I still needed to figure out how I could scrimp and scrape to get that 401k maxed out. And fortunately, I did that year. I did max it out, and I've maxed it out every year since. And that's one of the main reasons why I've been able to reach the level of financial independence that I'm at. And that's what we're teaching you. So we're not saying to do things that we didn't do. I mean, we've been doing these things ourselves, and that's what's led to our success. We're just trying to share that success with you by encouraging you to do some of the same things we've been doing for many, many, many years. So great suggestion for end of year planning, Tyler.
100%. Yeah. Next is planned charitable contributions. This is another, depends if you're charitably inclined. It also depends on working, directly with your CPA and tax accountant to make sure that you're maximizing these from a charitable contribution standpoint, especially as tax rules have changed over the years. The ability to deduct certain things has also changed, so just give consideration to that. But one of the things that we do handle with portfolios, especially pre-tax retirement accounts, is QCDs, or qualified charitable distributions, is something that we assist our clients with. When they deem with their CPA and accountant that it's a good plan for them and strategy for them. So if you're somebody that wants to donate to whatever organization that qualifies for these deductions that you're passionate about, give consideration to it definitely before the end of the year, hopefully with a lot of time before the end of the year, so that way you're not stressing your advisors out.
We do appreciate that.
Yes, we do.
Give us a heads up.
Yes, please. On how much you want to do and to whom you want it to do it to. But it can be a great strategy for taking money out of taxable accounts, and if you're done properly and structured correctly, you can actually not have to pay any taxes on that taxable money that you otherwise would have had to pay taxes on if you just distributed it to yourself as taxable income. But by donating it to a charity, church, organization that qualifies for the deduction, you're able to pass the money along to them, and no one pays taxes on in that format. So a cool strategy that often a lot of people don't realize exists.
Yeah, absolutely right. Yeah. QCDs, qualified charitable distributions. Yeah. You have to be 70 and a half years old, I believe, in order to be eligible to do that. Once you're 70 and a half, you can do qualified charitable distributions. Even if you don't have any required minimum distributions at that time, they left that 70 and a half the same for QCDs. And you can do up to $100,000 a year, I believe, at this point in terms of qualified charitable distributions. So that means, maybe you have $1 million pre-tax retirement account, and you've got plenty of income coming in from a pension or Social Security or other sources of income that you might have coming in, and you're just thinking that extra $1 million is going to get left behind. Well, you leave it to your kids or grandkids or other normal human beings. They're going to end up paying income taxes on that money. And you may have some estate tax consequences on that money as well. That's, especially looking at the state of Oregon, for example, pretty much everything over $1 million can get hit with estate tax consequences. So your heirs could end up losing a huge chunk of that money, that $1 million pre-tax retirement account, because of income taxes and estate tax consequences, such that they might only get $200,000 or $300,000 at the end of the day out of the $1 million. Alternatively, you could give a full $1 million to charity. If you did qualified charitable distributions out of that $1 million, you could give that to charity, and the charity's not paying those tax consequences on. Now, maybe the state of Oregon or whatever state you live in, or the IRS is one of your favorite charities. If you want to give them extra money, they will take it. But if that's not your bag, then I would say look for legal ways to make sure that the money goes where you want it to go. You worked hard to earn it. It's going to go to one of three places. It's either going to go to your family, your live individuals that you want to leave it to, family, friends, loved ones, and so on, or it's going to go to charity, or it's going to go to the IRS. And deciding how you can apportion your assets and your wealth to make sure it goes to where you want it to go. It's a big part of the estate planning stuff that we help clients with also.
Yeah. Okay, final.
Yeah.
Reviewing your estate plan / reviewing your beneficiaries. So this one probably gets kicked down the road the most by people from my experience, because it's not exciting to talk about your estate plan and what's going to happen when you're no longer around to control your assets and who the money that you've accumulated goes to and all that stuff. But it's very important. It's it drives me crazy when we have clients or people we know pass away and they didn't do proper estate planning or setting up their beneficiaries, and the money just goes to the wrong hands. And a little effort can go a long ways when it comes to setting up your beneficiaries, and at a minimum, just reviewing them once a year, reviewing your employer 401k plan, reviewing any IRAs and Roth IRAs you have, considering if you don't have any estate planning, at least setting up a basic will. And please don't take any of this as legal advice. So definitely consult your attorney and other qualified sources. This is just general guidance on this stuff and how we understand it. But at a minimum, give consideration to all those things, because like Tim mentioned just a minute ago, you're working hard for everything you're accumulating. You're socking away money. It's difficult, we know, but you're doing a great job at it. Make sure it goes to the people you want it to go to at the end of the day.
Spot on. Yeah. No,
That's it.
Completely agree. You could drop the mic on that one. That's
boom.
That's pretty.
This is on a stand. I can't drop.
Oh,
this
you're
in.
right. You're right. It's actually hooked up. So if you come into our office, you'll see what the podcast studio looks like.
That's right.
So I guess the only thing that I would piggyback on,
Please.
On the estate planning is one of the exercises I do every single year. And if you may have heard this in a previous podcast, if you've been listening to the podcast, but I just did it again recently, this last week, is go sit down with yourself. Put some noise canceling headphones on or something like that. Grab a sheet of paper and grab all of your legal documents and ask the question. So make sure you have an hour for this. And that's generally my recommendations. Have an hour. Ask the question, if this is the year, if I die in the next 12 months, or if I get disabled in the next 12 months, is everything going to go the way I want it to go? And then read your legal documents. That's free. It doesn't cost you anything to read your own documents. You purchased them if you had an attorney help you with them. If you don't have them, then there's a good sign that you need to take a look at that issue. You probably have a gap in your plan, because if you don't have a will, by the way, the state that you die in has one for you. That's what it means to die intestate. It means that you're going to use the state's will. So hopefully they do with your money what you would like them to do with your money. Most people don't want to rely on the state to do with their money what the state wants. They would rather do what they want to do with their money. So read your legal documents and just say, if this is the year, is everything going to go the way I want? And if the answer comes back, yep, then great. You don't have to worry about it for another year. And if after you read it, the answer comes back no, or I don't know, then you should probably talk to your attorney, make some adjustments to your estate plan, and make sure that it does reflect what you want to have happen if this is the year. Because one year, it will be the year. I mean, we all hope it's many, 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 many years from now. I know I do. But just reviewing my own trust documents and everything this last week, I found half a dozen different edits that needed to be made, and my attorney's working on them right now. So it's something that, again, we do from experience. We're not telling you to do things we wouldn't do ourselves. These are exactly the same kinds of things we do in order to be successful, in our opinion, and we want you to be successful as well.
Yep, absolutely. Well, that was fun.
It's probably exhausting. You're watching this, listening to this, you're like, I have all this work to do.
Yeah, no, don't. Okay. Well, you got time before the end of the year.
That's right.
When this podcast should release, you still should have plenty of time to tackle all this and have plenty of buffer on either end. So don't let it stress you out. Okay, just the answer. You ready?
Yes.
Okay, the question of the day is year-end checklist. Are your finances in order? The first thing Tim and I talked about were RMDs. Maybe you want to hit on why those are important?
Why don't you do the summary today,
all right,
Tyler?
I'm going to do just the answer. Okay.
You hit it.
Year-end checklist. Are your finances in order? RMDs, if you are of the age where you have to take a required minimum distribution, RMD for short, make sure you do it before the end of the year. It's not worth paying the penalty taxes to Uncle Sam and the IRS for not taking that RMD out. So work in conjunction with your accountant, your CPA, as well as your financial advisor, if you have one, to make sure to figure out what is my RMD. Have I taken enough out? If not, how much more do I need to take out and get that done before the end of the year? Second thing we talked about was tax loss harvesting and rebalancing. We also mentioned that tax loss harvesting can also be referred to as tax deduction creation, which is, like I said earlier, easier on the ears. And it's a concept of, in a taxable brokerage account, selling and buying stuff in the portfolio to generate gains and to generate losses to help offset each other. It's also a strategy to help realign all the investments in your portfolio. Tim talked about the pizza analogy as well as the tires on your car rebalancing analogy to bring everything in line with the intended allocation as things drift and move due to market performance, whether it's good or bad. So those things are happening in the portfolio naturally. Make sure that everything still aligns with your intended goals for the allocation. Next thing we talked about was maximizing retirement contributions. So if you're contributing to any retirement account, whether it's a 401k, other employer sponsored retirement plan, whether you're doing it yourself with a traditional IRA or Roth IRA, if you want to make sure that you're hitting the max cap on those accounts as far as how much you're saving into them, do it before the end of the year. They don't have a lot of flexibility. Some of the accounts have more flexibility once you go past the end of the year, but as a nice line in the sand, try to target December 31st as making sure that you've hit the maximum that you want to put into those accounts by that time. Fourth thing we talked about was planning charitable contributions. So if you're charitably inclined and you have organizations you're passionate about, and donating to those organizations is what you're passionate about, plan it and do it strategically in a manner that's not only tax efficient, but works for you and the assets you have and the way you want to do it. One thing that we as financial advisors help our clients with is QCDs, stands for Qualified Charitable Distributions from taxable retirement accounts. That's a way to satisfy your RMDs that we talked about earlier, as well as donate to charities and not have to pay the taxes on the money coming out of those taxable retirement accounts. If done properly, and again, work with your CPA and a tax account to make sure you're dotting the I's and crossing the T's on that stuff. Last thing was reviewing your estate plan and your beneficiaries. So you're working hard to save and plan for your retirement, whatever you're planning for. Last thing we want to see is something prematurely happen to you or anything happen to you, and then your money not go to the intended recipients that you want it to go to. So review your estate plan, review your beneficiaries. If any updates are needed, jump on it, get it done while it's fresh on your mind, and put it behind you. Essentially.
That was awesome.
Yeah.
That was good, Tyler.
That was fun, man.
That was really good for you, man. That was
cool.
good. That was
That
good.
was
Just
fun.
the answer. I'm just excited. I'm literally watching like the veins on his head bulge as he's like telling you all this brilliant stuff. So
I'm just like,
pretty
Rah.
cool. Anyway, no, it's great. It's great. There was a lot of really good meat in there, and this is just like all of our podcasts. It's just the tip of the iceberg on the stuff that we can share and teach. And,
All right, now it's your turn.
Oh.
It's your turn for trivia. As we
trivia
always
time.
do. It's been a while.
It's trivia time.
It's
Okay.
trivia time.
All right, what do you got for
This
me?
is a fun one.
Okay.
Well, they're all fun, but
All right.
Okay. What is the driest place on Earth?
Ooh.
I'm going to give you some options.
Okay.
Okay. Your first is the Gobi Desert in China, Luxor in Egypt, Dry Valleys, Antarctica, or Ica, Peru.
Oof. Oh man, that sounds horrible.
Yeah, it does.
I have no idea. I do not particularly enjoy dry places, so it's not like I really want to go visit any of these places right now.
Me
That
either.
doesn't sound exciting at
I need
all.
water. I need water.
This is a total dart thrown to the dartboard.
Yeah.
I'm just gonna go with I'm gonna go with the weird one. Let's go with the Antarctica one. That's fine.
That's
So,
right, man.
Is it?
Yeah. Dry Valleys, Antarctica.
Dry Valleys, Antarctica.
A little bit of an oxymoron, if you ask me. Not what you would expect.
Right.
In Antarctica. One of the coldest places on Earth.
Yeah, what is it? Like some
I have no
dry
idea.
place on top of ice?
I
guess maybe it's
imagine,
been frozen
yeah.
for so long.
I didn't look too much into it, so maybe the listeners can Google it,
So
pull up a
be it.
YouTube video, and
So be it.
educate us when you come in to meet with us, because we'd love to meet you.
Yes.
If you feel like our services or our expertise might fit you and what you're looking for, give us a call. We don't bite, promise. And how can they reach us, Tim?
They can reach us by calling 503-579-1000. Or you're welcome to check us out on our website, clearfp.com. You can also email us at admin, A-D-M-I-N, at clearfp.com. So lots of ways to get in touch with us.
Yeah.
Easiest thing, though, is just pick up the phone, give us a call. 503-579-1000.
100%. That was great.
Yeah, well, I concur.
Any final words?
Final words of wisdom. There's a lot of stuff to do to optimize your retirement income plan, your overall financial planning strategies, and make sure that your family's protected, your taxes are minimized, and your income is optimized. It's hard to keep up with a financial advisor where that's their whole job. I mean, I've been doing this 27 years, since 1997, and I have no concerns about you learning too much. We don't hold things back here. We try to teach you as much as you want to know. Not worried about you ever catching up, because I will never catch up to the stuff you know in your field of expertise. I could never catch up to that. You know so many things. I know a lot in this field. Tyler knows a lot in this field, and we're not afraid to share that knowledge and help you use it to optimize your life situation. And with that, I think we're good.
I love that. Thanks for sharing that. And thank you
joining
guys
us.
for tuning in.
Yeah.
Investment advisory services are offered through Clear FP Advisors, LLC, or registered investment advisor. Securities are offered through Clear FP Securities, LLC, member of FINRA IPC. Exposure to ideas and financial vehicles discussed should not be considered investment advice or a recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments may fluctuate and when redeemed may be worth more or less than when originally invested. Financial professionals are not licensed in all 50 states. To find out if Timothy Claremont is licensed in your state, please contact his office. Clear FP Advisors, Clear FP Securities, and Clear FP Life LLC are not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide tax and/or legal advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Clear FP, LLC NPN number 194283777 and or Clear FP Securities NPN number 197499604. Any discussion of general investing strategies or specific securities are for conversational purposes only and should not be taken as a guaranteed endorsement or recommendation.